Hey, welcome back to Everything Money. We're glad you joined us again. Of course, this is Seth, Paul, and Mo. We're talking about stocks and building your wealth, those cliche terms that Paul hates. Today, we're talking about Microsoft. It's a small little company, very small market cap. This is penny stock, or am I wrong? Microsoft's the biggest company in the world. They do the software. Paul, tell us your thoughts on Microsoft, baby.
First off, follow us on Instagram. It helps us out a lot. So Microsoft is a $2.2 trillion company.
Yeah, boy.
Seth, look at this. Our first pillar is the 5-year PE. We want it less than 22.5. It's 60. So I'm immediately going to say, guys, how do you justify a higher PE?
I hit the wrong sound drop right there. Keep going.
You justify a higher PE with more growth potential. Is it possible that literally the largest software company in the world has amazing growth? Maybe it is, but I don't think in the world of investing and being conservative, that's the proper assumption to make. And as we go later in the video and do our stock analyzer tool, you'll see us input growth assumptions and see where it goes. But either way, this is a massive X. Now, return on invested capital, huge. Software companies tend to have very large returns on invested capital. They do a great job.
We'd like this over 9 for
we want it over 9, yes.
17 is really good.
Sethi, they have a dividend yield of 0.7% that pays out $16.5 billion a year in dividend. Now remember, guys, this dividend is supported because we look at the free cash flow. The 5-year free cash flow average is $40 billion. That means they only pay out 40% of their free cash flow into dividends, but last year's free cash flow was $56 billion.
When Paul says supported, obviously, if you've been looking around, if you're a dividend investor, these are not always safe, concrete numbers. I have AT&T's changed theirs. Geo Group was a dividend trap. So be careful out there if you're a dividend investor. They have to have that free cash to be paying you. Go ahead, Paul. Pillar number 3 is revenue growth over the past 5 years, maybe.
Now, if I was sitting here right here, and this was 2017, I would have said, guys, what are the chances that 96 billion becomes 150 in the next 5 years? I'm like, probably very low.
Yes.
Yeah, guess what? It hit 168. So that's what I say, guys. I'm not here to say that I'm 100% right. What I'm trying to do is say, if I have 100 Microsofts, are they going to go, are all of them going to go from 96 billion to 168 billion in revenue over 5 years? Probably not very likely. My goal as a value investor is to make conservative assumptions and buy at lower than intrinsic value. But right here, they've killed it the last 5 years. 96 to 168 billion in revenue.
So, Paul, the problem is, I think a lot of our comments we get is when we're so sort of bearish on a lot of these companies.
Well, it's not bearish, it's realistic.
That's it. And then people say, but just imagine if you would have caught Facebook and,
I have no FOMO.
and Amazon.
And I would say to you, imagine if you had not bought the losers that you bought.
Yeah, that's the point, folks.
And if you haven't bought losers yet, you haven't been in the market long enough.
That's just it. Like people say, boy, Paul, you're so wrong. Imagine buying Amazon back in the day. It's like, well, you might not have bought Amazon. You might have bought pets.com and had nothing instead.
Oh, you would have bought more than pets.com. You bought MVP.com and all the ones that went to zero. Because I once did an analysis. I had one of our patrons do it, where if you bought every hype stock in 2000.com and waited to today, you would have made 3% a year versus the market doing like 7% a year. And 80% of that 3% would have come from 3 companies. So you'd have lost your butt on so many other companies. And you'd be like, but I was right on these 3. And even with Amazon, Apple, and Microsoft being huge gainers, you would have bragged to your friends about, you still would have lagged the market just by getting 3% a year. So it's your decision. At the end of the day, the more you pay, the less you make. That's it. Profit, 25 billion to 61 billion. Is that good? That's awesome. You know what I love even more?
Shares outstanding, pillar number 5, baby.
It's not as good as I thought, but it's still lower. 7.72 to 7.53. I can assure you that they will be buying back a lot of shares in the future. They're spitting out so much cash. It's just hard to deploy tens of billions of dollars a year. And they're going to look at the dividend and say, it's not tax efficient. Let's start buying back shares.
If you're in love with the software behind Paul, he'll tell you how to grab it right now.
Guys, our software was made because our users requested it. They wanted to see how we analyzed it. Now we're making the software the hub for everybody to learn about financials. And with the software, this is what you get. You get our mobile app. You get the 8 pillars. You get the 30 years of financial data, stock analyzer tool, exclusive daily content just for our subscribers, access to all of us, all of these things, including the Discord community, which is most important. Over 6,100 people are in there right now that are like-minded investors who you can talk to about all your ideas. How much is this? 87 cents per day, less than a cup of coffee. Our competitors are $1.99 and $35, and they don't give you everything we get. This is a no-brainer, guys. If you're serious about investing, this will pay itself over hundreds and hundreds of times in your lifetime. Don't be foolish. Get the software today.
Okay, Paul, after pillar number 5, we go to pillar number 6, which is total liabilities divided by free cash flow, 5-year free cash flow. We want this number under 5, Paul.
So when Bill Gates started, this is a well-known story. When Bill Gates started Microsoft, his goal was that he wanted to have 6 months worth of payroll in the bank account so that he could always make payroll even if their software went nowhere. So what we're doing here is, our idea is you take the 5-year average free cash flow, you multiply it by 5. In this case, it's $200 billion. I want their long-term liabilities to be under this number. Why? Think about it this way. Think about your personal life. Let's say you and your neighbor make the same amount of money, have the same house, same cars, but for some reason, your neighbor has $10 million in debt and you have 0. Who is more likely to go bankrupt? Mm-hmm. That's it. And in the name of the game in a lot of business, people over-lever themselves, and when times are tough, it hurts them big time. So we want to see long-term liabilities less than $200 billion. It's very simple. We go to the balance sheet. We scroll all the way down to the bottom, $103 billion. It's about half. So they're fine. They can pay off all their long-term liabilities in 2.5 years of their cash flow.
Check, please.
That's phenomenal.
Perfect. So, let's go to pillar number 7, which is the grandpappy of them all, free cash flow growth, baby.
Free cash flow, guys, cash from operations, less your capital expenditures. This is the money that's actually coming into the business so they can pay dividends, buy back shares, make acquisitions, pay down debt. We want to see this growing. 31.4 to 56 billion. Check mark there with an average of 40. So our next metric is we take this average of 40 and we start by multiplying by 20. We just want to start at a point in time and say, okay, if we were to get this, we take the average of the last 5 years, multiply by 20, I want to pay $800 billion to this company. Guys, yes. However,
2.2 trillion.
Correct. So this is definitely an X. But I will say this, guys. You go to our 8 pillars tab, which is included in our software. The only metrics here are this and this. So we love the company, hate the price. But think about it. Their PE is 60 on this 5-year level. If the price fell to, if the company went from 2.2 trillion to 800 billion, this would be less than 20.
Yep. That would get us in the wheelhouse. Yes.
It gets us right to where we need to be.
So as Warren Buffett would say, we find a great company and then we wait till it's cheap.
And we wait. And you might sit there and say, oh, the stock's at 300. It'll never go to 100. Okay. If you think it'll never go to 100, you haven't paid attention to history. Stocks will go to where their long-term average should be over long periods of time.
And that's when we grab them, baby.
Yep. And that's where I look at it going. And guess what? In 2012, I was called stupid for buying Microsoft at $22 a share. I was called stupid. Why? You don't get it, Paul. This company is dead. These were tech people telling me the company was dead. Not investors, tech people. Mm-hmm. Right here. At $73 billion in revenue. They did 168. Is that a dead company?
Terrible.
That's like saying to me, Paul, you're dead, but you're speaking, eating, heartbeat, breathing, everything. That's exactly what it's saying. So,
and fully torqued. Speaking of fully torqued, if you want to be fully torqued in the Bitnass Nation and trade with Mo on maybe they're trading Microsoft, big company, Mo. If you're interested in trading this at a faster pace, maybe daily, you can join Mo in our community in the Bitnass Nation. Mo, so tell us what's going on over there.
There's a lot of people that are trading this one, and for good reason. I mean, it did a sweet spot reversal recently, and it's had a great trajectory up, tons of additional add points, and it's just going sideways up here. So right now, I would probably caution you to maybe take some profits. And the reason is we're starting to get the red lines under the yellow. It's starting to ticker down. I would not exit my position, just maybe take some profits off the table. And then wait until you go and make these all-time highs again. Break out a couple times, get some good engulfing candlesticks, break out over that all-time high with a good engulfing candlestick, and you will be okay here. Now let's look at it from a daily perspective to see if you can swing trade this. Again, great looking sweet spot reversal, extremely consistent volume, which is no surprise. If you can get over this 25-day moving average, what I just said you need to happen is going to happen. So pay attention to this one, keep a watch on it, you're gonna do very well.
If you join our community and get our software, you'll get the stock analyzer tool. This is the final piece of the puzzle, or the pizza, Paul. You know the pizza. And how should we value this stock? We actually haven't mentioned the ticker price yet, and this is where we get into it. Go ahead.
Yeah, I actually did. Did I mention? I did mention the ticker price of 300 going down to 100, but it was only in passing. So guys, what we do here is we make assumptions, low, middle, and high assumptions for everything that matters in valuation from a 500-foot view: revenue change, share change, etc. I've made conservative assumptions. The reason being, I want to be conservative because I could be wrong in so many ways, right? And you have only so much money to invest. Your job is to be conservative, but not kill the deal. Look at my assumptions here. I'm looking for 15, 12.5, and 10% returns. I hit analyze. And guess what, guys? My middle number, remember what I said before?
100. Yeah.
100. So the middle number, even on the high side, 156 to 172 is currently paying. So I want to show you guys how much this matters. Let's go to the high side and say they did 15% a year. I want to show you how overpriced Microsoft is. It's still too overpriced. I went and changed the high side revenue growth from 9% to 15, which is on the 15%, as you can tell, they did that in the last 5 years. Last 10 years have done 10% revenue growth. This is assuming 15% revenue growth from here on out. It's still too much money. The stock is just overpriced. In my opinion, does that mean I could be wrong? Absolutely. They could all of a sudden figure out a way to double their revenue in the next 2 or 3 years. I have no idea. But the point to me is be cautious. Add this to your watch list, which is coming soon on our software, and you'll be able to watch for it and set the price target. When it hits it, you go buy it.
Click the link below to join our community. You can trade with Mo, you can invest with Paul, and you can follow all of us as we make our investing decisions and do this together. It's a great team we have, and we're happy to have you guys on it. So that's our take on Microsoft. Fondle the thumbs up like you tickle Paul's belly on the way out. And you know those community, those bid and askers. Keep that bid and ask tight, Mo. You know that. Keep it super tight. Love you. See you next video.